We're back on Morning Trade Live. We'll get a closer look at the defence industry tomorrow when we get earnings from Lockheed Martin, RTX and Northrop Grumman ahead of the opening bell. Here's what these stocks have done this year. Northrop and RTX both up more than 25% this year. Lockheed Martin is just above the unchanged line in 2025. Let's go inside out on the defence segment. Joining us now is David Dietze, Chief Investment Strategist at Dietze Wealth Management Group. Thank you so much for your time today. Dave, what are your expectations across the board for these defence companies this time around?
Well, we're generally very positive. I think the key thing, of course, is we're going to see revenue growth in these companies in the high single digits. Having said that, of course, profits actually are going to be slightly down year over year. And that's due to a variety of issues. One, of course, is the tariffs are affecting them. There are some hijinks in the supply chain. They also are, to varying degrees, dependent on rare earths. So the earnings expectations are a little bit muted. Having said that, you can see from the charts there that with the exception of Lockheed Martin, most investors are fairly bullish on the long-term outlooks for these companies with the year-to-date gains.
Okay, interesting. So a little bit of a mixed expectation then you could say with revenues, as you say, in that sort of high single digits and profits expected to be down, weighed down by no doubt some of the geopolitical tensions, as you mentioned. We've got the rare earth situation going on as well. So who then is sort of well placed or best placed right now as far as the earnings picture is concerned?
Yeah, absolutely. So if you're looking for the value play, I got to go with Lockheed Martin. As you pointed out, that company's year-to-date performance is near the flat line. They're trading with just about 17 times earnings, which is a discount to the S&P 500 and a discount to their peers. They also have a better dividend, close to about 2.6%, well above the S&P 500. All the other companies are under 2%, in some cases under 1%. So I think there's a little bit of skepticism there. But at the end of the day, the United States government can't do without Lockheed Martin. Of course, they are the maker of those F-35s, which is everyone's favorite plane, although there's been some talk about perhaps them having to step up their game with that particular model. So that's your value play. In terms of your basic, diversified, high-quality play, I like Raytheon here. It's got a good mix between commercial aerospace business and defense business. Of course, they're the maker of the Tomahawks. Those have been in the news now. We can't seem to get enough Tomahawks. Everyone in the world wants Tomahawks. So they're really on the forefront. So we like Raytheon for a more expensive stock, but very high-quality, diversified play.
Okay, and I see there's been a couple of price target boosts for some of these names ahead of these earnings. Bernstein now looking at Northrop Grumman, looking at $674 from $630, so keeping a market perform rating on the shares. So, I mean, there seems to be some optimism going into this, but you mentioned some of the tariff impact, geopolitics, rare earths. What are these companies likely to say? What we should be looking out for as far as some of the remarks are concerned with a lack of visibility on that front?
Absolutely. So the biggest complainer recently has been Raytheon, which has talked about a hit to their bottom line of 500 to 750 million. The complaints of the other companies have been a little bit more muted there, and they've made some supply chain changes to reduce their exposure. So we certainly want to hear what's going on there. Of course, I think the other key issue is the government shutdown here. I do think you're going to see a boost in these companies' stocks if we can get a quick resolution. Obviously, to the extent they're dependent on government contracts, nothing is happening quickly now with a good portion of the workforce now sitting at home and or not really being paid. So that's another thing to watch for.
Oh, yes, you raised such an interesting point. Let's see what some of the commentary is around that to try to ease or at least reassure investors about a few of those issues. David Dietze, always a pleasure. Thank you so much for joining me today. Really appreciate it. Chief Investment Strategist, Dietze Wealth Management Group. Let's trade it now with Tom White, host of Fast Market. Hello to you, Tom. Happy Monday. So example trade first and foremost for RTX. How are you looking at that one?
Yeah, with the shares up 39%, expectations are pretty elevated in a lot of these names in the defense sector here going into the report. Option market pricing at about a plus or minus $7 move, just over 4% either way. So implied volatility levels in the near term options really elevated. So I have a strategy that takes advantage of, hey, I want the stock to move about that one standard deviation, but I don't have to pick to the bullish side or the bearish side. I looked at a double calendar position here where I'm going to go out to the October 31st weekly option, so 11 days to expiration. We're going to buy the 167.5 strike call and buy the 152.5 strike put. That's about that one standard deviation move either way in the shares. And then I'm going to sell those same options, the 167.5 strike call and 152.5 strike put in the near term October 24th weekly options that expire in just 4 days. So double calendar position, just 1 week wide, real short term positioning on this. You're going to pay a debit of roughly about 80 cents. So there's your risk, about $80 per spread. But you can see here from the risk profile, you want it to go either near 152.5 or 167.5 over the next 4 days. But at the same time, you still have a decent range between about 148 on the downside and about 173 on the upside to remain profitable. Now, why is this thing priced so low and it looks so good on a risk profile? Well, you're buying about a 37% implied volatility on aggregate in that October 31st weekly options on the call and put, and then selling about a 55% in the near term October 24th weekly option. So that vol dispersion lowers the entry point price on this double calendar position where you need a move, but you just don't want like a 2 or 3 standard deviation move, or you don't want the stock to kind of stay here near 160.
Okay, and switching gears to Lockheed Martin, as David Dietze put it, this is a value play. It is trading at a discount compared to the others. You've got a sort of more bullish example trade for us on that one. Now, what are you seeing?
Yeah, shares are only up about 3% so far this year, so it's lagged the sector as a whole, and the S&P 500 for that matter. So I looked at another strategy. If you're bullish on this name, you think it's going to go higher. Option market's pricing in about a plus or minus $20 move in the stock. It's a high-priced stock. So I looked at a bullish call diagonal here where I'm going to take advantage of that vol dispersion again, just like we talked about with the double calendar. But here we're going to go out to the October 31st weekly options. We're going to buy the 500 strike call, basically at the money, and then in the near term October 24th weekly options, I'm going to go about that one standard deviation level and sell the 520 strike call. So a bullish $20 wide call diagonal. You're going to pay roughly about a $10.50 debit for it. That's your risk on it, $1,050 per spread. But you can see here from the risk profile, anything above about 505 is going to be profitability on this one, and you're paying about half of what the width of this call diagonal. So you're getting good pricing on it, but you need a move to the upside just ever so slightly less than 1%.
Okay, a good look across the defense names there for us. Example trades on RTX and Lockheed Martin. Thank you so much, as always, Tom White, for checking in with some of those names.